Hello, everyone, and thank you for being part of another Power Hour with us, the Greater Chambersburg Chamber of Commerce. Today, I'm very happy to have on both Jay Goldman and Ben Bostic from Boyer Ritter, certified public accountants and consultants. Ben and Jay, really appreciate your willingness to come on and chat with us about this forever changing PPP loan forgiveness program. So thank you so much. For everyone who's joining us today, if you have any questions throughout, please do not hesitate to ask them in the group chat. I will do my best to monitor that. And if you would like to remain anonymous, just please go ahead and send the chats to me, Jordan Nace, and I'll be able to, read them off to Jay and Ben at the end here. We're hoping they do about an hour's long presentation here on the PPP loan forgiveness application, and then we'll save a little bit of time at the end for question and answer period. All I'm asking is everybody joining here today, if you could please make sure you stay on mute, obviously, except for Ben, Jay, and myself. That'd be very helpful. And again, please do not hesitate to ask questions. Just go ahead and type them in the chat if you're comfortable with yourself knowing everybody is seeing your question. Or again, if you'd like to remain anonymous, go ahead and send them over to me. But without further ado, Ben, Jay, again, thank you so much for being here, and the floor is yours.
All right, thanks, Jordan. We appreciate the Chamber giving us the opportunity to do this for you all. I feel like I should be getting ready to see all you at the Kennebec Mixer here, but guess that's not going to happen. Regardless, it's great to see so many familiar faces on the registration list. And if our governor ever lets our county go green, I can't wait to see you again in person. Before we get started, we think having a copy of the loan forgiveness application in front of you will be helpful, as we'll discuss many topics that are directly in it. And before we get started, I just need to issue a quick disclaimer. This webinar is for general educational purposes. It shouldn't be used for legal or accounting advice. Neither one of us are lawyers, and while we're both CPAs, we don't know all your facts, even if you're already one of our clients. Anything you hear today, I would discuss with your advisor before acting one. So there's lots of unknowns, and I can't emphasize enough that it's literally changing on a daily basis. So we've done our best to make sure that this presentation is as accurate as possible on June 5th at 12:33, or what I like to refer to as March 77th, because I refuse to acknowledge the fact it's June based on the amount of work I still have to do from this last tax season. Parts of this presentation could literally be outdated before we finish. So again, this is the best we can do as of right now. We're going to share with you what we know, what we think, and we're not going to hesitate to tell you when we don't know something. And if we don't know it, it's because the answer doesn't exist at this point. Okay, so as of 9:30 this morning, this webinar was completely changed. We had planned on spending most of the day presenting the actual application, but as things change, we must too. So first part of this presentation will be on the PPP Flexibility Act that was literally signed as of 11 o'clock today. So lots of changes are happening. And then after that, we're going to dive into the actual Paycheck Protection Program loan forgiveness application. Today's presentation is going to be following one major assumption, that everyone on the line has a basic understanding of the PPP program and the loan forgiveness concept. We have a lot of webinars and articles on our website, so if we don't touch on a topic that you're curious about, we probably have already addressed that in one of those webinars. And if you subscribe to our website, you'll get all the updates as they come, as we're putting out material almost every day. Okay, so let's look at today's agenda. First, I'll be going over the PPP Flexibility Act of 2020. And then Jay and I will be going over the PPP loan forgiveness application. Jay will discuss some unanswered questions, and I'll go over our BNR PPP workbook that I think a lot of you are already using. So let's look at the actual, I keep wanting to say bill, but it's actually a law now, because as I said, Trump signed it about 11 o'clock. So last Friday, the House passed the bill, ruining Jay's weekend one more time. And then late Wednesday night, they passed the bill. So when I woke up Thursday morning, we knew we were going to need to make some changes. And then literally, as I said, as 11 o'clock today, the president signed the bill into law. So the first thing the law does is it changes the loan maturity. The original law said that your PPP loan could not be longer than 10 years. Treasury and SBA came in and said, we're going to use 2 years as the loan maturity. The new law says that any new loan will be for not less than 5 years, but not more than 10 years. So we'll have to see what the SBA and Treasury decide. The law, this is the only part of the law that's on a prospective basis. So if you already have a PPP loan, it doesn't change your current loan. It's still at 2 years, but you can work with your borrower to see if they're willing, or you can work with your lender to see if they're willing to change your existing loan. The next thing the law does is it extends Section 1102 of the original law. And 1102 was all the allowable costs. So the old law said, as of June 30, you can use your PPP funds up till June 30 on allowable costs. The new law extends that to December 31. So you're able to use your PPP loan proceeds on payroll and non-payroll costs that are listed as allowable up through December 31. We also think this extends the time period you have to apply for a loan. So there is still a decent amount of money. I think as most of you have seen, the rate that the loans have been going out has dropped drastically and was even going backwards for a while there as people were giving their money back. We think this law will actually extend the period. So you could borrow, you could get a PPP loan after June 30, but it's our recommendation that if you're already thinking about a PPP loan, you should probably apply as soon as possible, because the changes in this law is going to make it more favorable, and there may be another rush on the money. The next thing the law does is it changes the covered period, and I think this is one of the most important aspects of the loan program. So the old law said you have 8 weeks from the day you get your money to use it for forgivable costs. The new law extends that to 24 weeks or December 31st, whichever comes first. I think for everyone it's going to be 24 weeks. But if you're a business that's already been operating and using all your money kind of in a rapid enough pace that you are going to use it in the 8 weeks, you can opt to maintain the original 8 weeks. You do not have to switch to 24 weeks. The next thing the law does is it changes the rehire provisions. The original loan said you had to basically rehire everyone back by June 30 at their original rate. The new law takes that to December 31. We'll have to see some of the applications of this. We think it mostly will apply to the FTE and salary and wage safe harbors we'll discuss later, but we'll just have to wait and see. The new law also creates a few FTE exemptions. If you read the original law, you see that there was actually no exemptions in the original. But then with FAQ 40, Treasury created an exemption that said, if you laid off somebody and you tried to bring them back and they said no, then you wouldn't be penalized. Because as you all know, it's difficult to bring back employees right now who are on unemployment and getting the extra $600 a week. But there was an IFR issued after the fact that said, in order for this exemption to qualify, you do have to report them to the state unemployment office. So it will jeopardize their ability to collect unemployment. So the application actually creates 3 additional exemptions as well. The first one's for if you fire an employee for cause. There's another one if your employee voluntarily resigned. And lastly, there's one where if they agree to reduced hours would probably be someone who needs childcare and is not able to work their full period. Now, the new law actually creates 3 additional exemptions. The first one is it provides you an exemption if you're unable to rehire someone. So the best example of this would likely be if you laid off somebody and they took a job somewhere else. They may not fall under the previous exemption, so it gives you a way out for that person. The next one provides you an exemption if there's an inability to hire similarly qualified employees. And I think this would be important for all our clients that have welders or they're in a specialized trade where it's hard to keep those employees because they're in such high demand in our area. And the last exemption it creates is if you have an inability to return to the same level of business activity due to compliance issues issued by HHS, CDC, or OSHA. So we'll have to see exactly what that means. It doesn't point out what happens if your governor doesn't allow your business to open. So again, we'll have to see what happens. The bill also changes the limitation on forgiveness. The old law didn't have anything in there. And then the SBA and Treasury created several 75-25 rules. And basically, prior to this law, they said you cannot use more than 25%. Your loan forgiveness could not be more than, non-payroll costs could not be more than 25% of your total forgiveness. The new law changes this and allows you to use up to 40% of your loan on non-payroll. But there's an issue with the law here. It creates a cliff. And that cliff is basically the way they drafted it, it'll be interpreted as if you do not use at least 60% of your loan on payroll costs, you will get no forgiveness. So this wasn't Congress's intent, and they've already identified this as an issue, and they'll plan to put something out there to correct it, but we'll have to wait and see what they issue. The law also extends the deferral period. The original law said you don't have to make any payments for at least 6 months, but you definitely have to make them before 12 months. SBA and Treasury kind of put a flat number on it and says you have 6 months of no payments of principal, interest, fees. The new law actually extends it quite a bit. It defers the amount until your loan forgiveness is remitted to your lender. And we'll see on the next slide here that time you have is pushed way out. So the law actually extends the time to apply for forgiveness. Up until now, we didn't know when you were going to have to apply. We were telling most people you're going to have to wait till at least June 30, because June 30, there's several tests originally that were at June 30 you'd have to wait for. Now the new law says you have 10 months after the end of your covered period to apply for forgiveness. So if you think about it, when you get your money, you have 24 weeks to use it for, you have 24 weeks to use it in your covered period, and then you have 10 months after that to be able to do it. So you're going to have at least 13 months after the day you receive your money to be able to submit your application. So you could potentially have 13 months of not having to make any payments. The next thing is pretty important. It allows a delay of payment of payroll taxes. I'm not sure how many people understood this. The original law allowed businesses to defer the employer portion of Social Security taxes from the day the bill was signed on March 26th through the end of the year. And then you're required to pay those taxes you deferred on December 31, 2021 and 2022. But the original law said if you get a PPP loan, you can't do this. Treasury and SBA came out and softened it a bit. They said you can defer payroll taxes up until your forgiveness is received. The new law makes this a lot easier. They say if you get a PPP loan, you can do this deferment. So let's stay on this for a moment. I want to go over an example because I think this will give you, all the businesses on the line a great opportunity to free up some cash flow. So if you had $1 million of taxable Social Security wages from the day the bill was signed, March 26th, we'll just call it the second, third, and fourth quarters. If you had $1 million of Social Security, taxable Social Security wages, you would be able to defer $62,000 because the employer portion is 6.2%. So that's $62,000. You could keep all of it up until December 31, 2021, where you would have to pay back $31,000. And then in December 31, 2022, you'd have to pay back the rest. So it'd be about a $62,000 tax-free loan for about 2 years, which is a pretty good opportunity for businesses that are pretty tight on cash right now, as businesses is pretty limited right now. The last thing about the law I want to discuss is something that's not even in the law. And so the original law said whatever forgiveness you get is not going to be taxable. And everyone was pretty excited about that. But the IRS came in and ruined everybody's fun. They said, our rules say if whatever expenses you incurred to make non-taxable income, you can't deduct those. So it basically undid what everybody wrote in what they wrote into Congress. The new law doesn't address it, and we're not sure why, but I think they wanted to get the bill passed because a lot of you are already pretty far into your loan. So they have until the end. They have until the rest of the year to figure this out. So we'll just have to wait and see. But as of right now, the expenses aren't going to be deductible. So you're essentially going to have some additional revenue you'll have to pick up. Okay, that covers that act. Let's actually go into the application. So on Friday, May 15th, SBA released Form 3508, the Paycheck Protection Program loan forgiveness application, and this completely ruined Jay's weekend. They have a habit of doing that on Friday evenings. As we expected, the application answered a lot of questions we had, but it did raise a few questions as well. And true to form, it let us know that there will be more guidance to come out, and they've kept up with their word because they keep pushing more information. And we still expect a lot more information to come out as there's still a lot of questions unanswered. So let's look at the components of the form. The form is not very long. It's actually only 11 pages, 5 of which are instructions. There's 4 pages of forms you can complete. There's a 1 page of certifications you'll need to sign. There's 1 page relating to the documentation you'll need to submit and also retain. But before we go any further, I do have to address the fact that the rest of this presentation is assuming that some dates and percentages will change as a result of the act that was passed, but the overall approach will remain unchanged. So let's look at the 4 forms in the application. On page 3, you have the PPP loan forgiveness calculation. On page 6, you have PPP Schedule A. And then on 9, you have the Schedule A worksheet, which has tables 1, 2, and it's got a safe harbor calculation you'll need to do. But the application, to be honest with you, is pretty weird. You're going to have to work backwards through it. You're going to have to do page 9 before you can do page 6. You're going to have to do page 6 before you do page 3. So the rest of our presentation, we're going to be going through the application actually in backwards. We'll go backwards through it to be able to address all the issues. And then the last page is an optional demographic information form. So this form, I'm not going to spend too much time on because it is optional, and I don't know how many of you are going to complete it. You're going to have plenty of other work to do. I will just point out it shouldn't impact your forgiveness if you choose not to fill out this form. On page 10, you have all the documentation you'll be required to submit and retain. It's pretty straightforward. If you read through, you're going to need to provide things such as like bank statements, lease agreements, payroll records, payroll taxes, different things. It's all laid out pretty simple to follow, but it will be a lot of information. I'm not sure how your bank's going to require you to submit it, whether it's electronically or how it will be. There's also information you're going to have to retain for 6 years. And this will basically be a person-by-person record that helps support all the information you're going to put into Table 1 and Table 2. It should also support all the safe harbor calculations you do and the forgiveness reduction calculations you'll have. Again, you have to retain this information for 6 years. Okay, before we get into the rest of the application, we need to kind of take a pause and we look at the incurred and paid issue that was created by the Act. We weren't sure how the SBA was going to interpret this. We weren't sure if you're going to be able to use all your expenses incurred, or could you only use the ones that were paid. Originally, we're kind of taking the most conservative approach was the expenses had to be incurred and paid in the period to be able to deduct them. Fortunately, the application helped make this information a little bit easier to work through. The first thing it does is it actually creates an alternative payroll covered period. So for payroll purposes, what it does is it allows you to start your payroll covered period on the first day of your next pay period. So what that means is if you received your loan on April 22nd, before this came out, you would have had to start your payroll on that day, and that maybe was in the middle of a pay period. But let's say you had weekly payroll, you could start your alternative payroll period on the beginning of your next pay period. So if your pay period started on Monday and you got your money on Wednesday, April 22nd, you would be able to start your covered period for payroll purposes then on Monday, April 27th. In this scenario, you're actually going to have a covered period that goes past the 8 weeks you would originally had. Now, I got to point out here, we have highlighted the 56 days on this slide, and that's because we assume that these 56 days will be changed to the 24-week equivalent. There's going to be a lot of places we'll have highlighted adjustments like this where we think that's how it's going to work, but as of right now, I mean, the law was signed at 11 o'clock. There's going to be some changes. The application also addresses expenses that are incurred and paid for non-payroll costs. And so this would be, for example, your utilities. So how do you account for electricity that you pay for after your 8-week period? Or can you count your electricity that was incurred before your 8-week period and then paid in it? What it did was it says, as long as you incurred the expenses during the period and paid them on their normal due date, you can actually deduct those expenses even if it's after your 8-week covered period. And so they issued an example that was really helpful that said, if you had a covered period that starts June 1 and it ends July 26th, you could and you paid May and June's electricity in that period, you can actually deduct May and June, and then you can also deduct the portion of your July electricity that was incurred during the 26 days, as long as it was paid on its normal period. So this basically allows you to take up to 3 months worth of expenses. Now, again, we'll have to see how this all works. It should simply be the same with a 24-week period, but we'll have to see. We're hoping with the extension of 24 weeks and being able to use more payroll costs or non-payroll costs, you'll be able to not have to be so aggressive with some of your approaches. You'll be able to use all your money on a timely basis. So with that, I'm going to turn it over to Jay, who's going to go through the rest of the application.
All right. Thank you, Ben. Appreciate that. So for those of you that are worried about the fact that I seem like I work every weekend, I've decided I'm not working this weekend no matter what. I don't care what the government puts out. So, but now let's fast forward ahead. Your 8 weeks are over, your 24 weeks are over, whatever it ends up being, and it's time to actually fill in the application. You've been spending your money, you've been collecting all your data, and now it's time to organize it and put it on a form. So as Ben said, we go backwards through the packet. You start on page 9, and page 9 has what the government refers to as the Schedule A worksheets. The Schedule A worksheets consisted of 3 sections. There's what they call Table 1, Table 2, and the FTE reduction safe harbor calculation. And we're going to talk about each one of those. So what you see here up on the screen is table 1. We added the highlights, they weren't there, but what it shows you at the top 2 bullets there with the highlights is which of your employees get reported on table 1. And that would be, they must have worked for you during your covered period. And that's actually good news, because under the original law, we thought you were going to have to track and monitor everybody who worked for you at any point in 2020, including before you got your loan money. But it's become clear now that you only need to worry about employees who were on the payroll and getting paid after you got your loan proceeds. In addition to that, in order to go on table 1, they have to be people who did not meet a particular exception, and that's the exception that we refer to as the 2019 $100,000 exception. And unfortunately, it's not quite that simple. You can't just look at their W-2 to figure out if they meet that exception or not, because it is a per pay period annualized calculation. So you'd have to look at what somebody made. You'd literally have to look at every single pay period for 2019 for every single employee, determine if the amount of money that they made in that pay period, depending on whether you're weekly, bi-weekly, semi-monthly, whatever, annualizes to more than 100 grand. So they could hit that in one pay period, not hit it in the rest, end the entire year under 100 grand, but still meet the exception. So table 1 is for the people who don't meet the exception. And the reason, and that's because we need the most information about them. So what goes on table 1? The employee's name, that's pretty easy. What they refer to as the employee identifier, which in the instructions they suggest or ask for the last 4 digits of the social security number. In the middle of the page is a column for cash compensation. This is all cash compensation paid to that employee during the covered period. But remember, there's a cap on everybody at $100,000. So when we were focused on this 8-week period, we all knew that was $15,385. No one person could account for more than $15,385 of your forgiveness. We assume that's going to be extrapolated out to 24 weeks, which gets you to about $46,000. But I guess there's a chance they'll do something different. So we'll keep our eyes on that. The next column over is the average FTE column. There's a whole bunch of different calculations that are impacted by FTE or full-time equivalents. They made it clear in the application, which we weren't sure about before, that it was going to be based on a 40-hour work week. There's other places where the SBA has used 30 in the past, but they went with 40. So anybody, if the person who you list on row 1, if row 1 is Ben Bostic and you put his last 4 and you put his money, and if he's a full-time person who works 40 or more hours every week, you put 1.0 for him. If he's less than 40 hours, you have 2 choices. You can use what they call the simplified method, where everybody gets 0.5. It doesn't matter how many hours they work if they're under 40. It doesn't matter if they're 10 hours or 39 hours. So one option is just to make everybody a 0.5. The second option is to actually do some math, figure out that if they averaged 32 hours per week over the whole time period, 32 divided by 40 is a 0.8. Everything gets rounded to 1 decimal place. So that person would be a 0.8. So you have to make a decision. You have to stick with your decision on all your FTE calcs throughout the whole process. And you might end up having to do it twice to figure out which one gets you the better answer. So that's what goes in that column. And then at the bottom, you'll see you'll add all that down. Also at the bottom, you'll see there's a row, not a column now, but a row for FTE reduction exception. This is where you take all the people who aren't in the table. Let's assume they got fired for cause and they're not in the table, or they're in the table, they were a full-time person, but they only worked half the time because they got fired for cause halfway through. So they might only be a 0.5 up in the table. So now you accumulate all those voluntarily resigned, voluntarily reduced hours, fired for cause. Now it'll be you were unable to replace them with a qualified employee because of skills or whatever. And you accumulate all those numbers and you add them into that, what's basically going to be the bottom line of that FTE column, so they get included in the number because you're going to add your way down. So that's what the FTE reduction exception row is for. Also on Schedule A worksheet, it's not part of table 1. It's actually the 3rd section down at the bottom. But since we're talking about FTEs already, it seemed like the best time to talk about that, is the FTE reduction safe harbor. And what they're doing here is, so the whole point of the FTE calculations are to track whether you've maintained your workforce at the pre-pandemic levels, and to sort of penalize you if you took the government's money but then didn't bring all your employees back. So that's what you're tracking when you do these FTE calculations. I used to have 100, I'm down to 90, therefore I'm only going to get 90% of my loan forgiven, as an example. But they're giving you an exception or an out where if you decreased your head count, in essence, because of the pandemic, and the way they define that is you decreased from February 15th through April 26th. And April 26th is 30 days after the law was passed. If you had a decrease in that time, but then you managed to get back up to the February 15th number by, currently it says June 30, we imagine that'll get changed to say December 31st. If you go down and then go back up and you get all the way back to where you were, they will consider you no harm, no foul, and they will give you the equivalent of a 1.0 rather than some kind of reduction. So this is a 5-step calculation that just walks you through, did you go down, did you go back up? And if you went back up all the way, you passed the test. And that doesn't actually get entered on table 1. I'll show you later on where that information goes. And then the final column on table 1 is the salary and age reduction amount. This one needs to be computed on an employee by employee basis. And this is where you have to compute and report the quote unquote penalty for reducing anyone's rate of pay by more than 25% as compared to the first quarter of 2020. So you figure out what you were paying them either on an hourly basis or a weekly basis. And then you figure out what you are paying them now on an hourly or weekly basis. And as long as you've stayed 75% or above, you'll be okay. But if you have fallen below 75%, you'll be penalized some dollar amount for that person. You'll have to go through the calculation to figure that out. And then you would put that amount in the proper cell that matches up with that person's name. You add all those numbers down and you put a total at the bottom. There's a safe harbor here as well, similar to the FTE safe harbor, which basically says if you reduced their pay after February 15th, but before April 26th, that'll be considered okay as long as you get them back to their full rate of pay by, and here we go again, June 30, probably going to be replaced with December 31st. So it's sort of a, hey, we understand you had to make certain decisions in order to keep your business alive, but now you've got our money, and now you've been spending the government's money, and now hopefully the world gets back to normal, and you got to get everybody back to where they were by some predetermined date, probably going to be December 31st. So that's everything that it takes to complete table 1. Next, you would go on to table 2. Same concept at the top. It's only people who worked for you during 2020, but these are all the people that did meet the exception. They were over that $100,000 during any one pay period in 2019. And therefore, basically the difference with these people is they are exempted from that wage reduction calculation that we just talked about, that 25%, 75% thing. So in essence, what they're saying here is if you take your highest paid people and you lower their pay by more than 25%, that's okay. I think the assumption here is they can afford it, which might not always be the case. But I think what they wanted here was if you had a high-powered executive making, if you're a big company and your CEO makes $1 million a year and that person agrees to go down to $100,000 a year during this time, they certainly don't want to penalize you for making a decision like that. So if you look at table 1 compared to table 2, you'll see 2 differences boxed out in red here. The far right-hand column is in table 1. If you look down at the bottom of the page, it's not in table 2. That's because, again, you don't have to make that calculation. There is no penalty. The other one is the FTE reduction exception line on table 1. And it's not that table 2 people don't qualify for that. They do qualify for that. It's just the way that they're mechanically having you do the math. You're putting all the FTE reductions in step 1 rather than in step 2. Ultimately, you add the 2 numbers together anyway, so you get to the same place. So it was just sort of the way they wanted to do the mechanics of that. Then you get to what we're calling table 3. If you look at the form, there is no table 3. This is where the owners go. So according to the instructions, owners are not employees. Owners are separate, and therefore owners do not go on table 1, and owners do not go on table 2. There's actually just a line on the form where you enter your owner's salary. But then that line says if you have more than one owner, create a table. So we're calling it table 3 just because it makes it easier for us to talk about it internally. But that's where your owners would go, and you only have to do it if there's more than one owner. So that would be the end of completing the Schedule A worksheet, which is on page 9 of the packet if you have it in front of you, or if you listen to this again in the future and have it in front of you. So after that, you would go to PPP Schedule A, which is page 6. this is where you start to sort of gather all the data together and actually start to do some math with it. So the good news is the hardest parts are done. That last page, that Schedule A, is going to take a significant amount of time, depending on how organized you've been throughout the process and what accounting software you use and what payroll service you use and stuff like that. That's going to take a considerable amount of time. It should speed up at this point once you get to page 6, the Schedule A. So this part, you start with the first section here, lines 1 through 3. All that information is just copied over from table 1. And then the second section, lines 4 and 5, that information is literally just copied over from table 2. The third section, these are the non-cash payroll costs or non-cash compensation payroll costs, things that hopefully concepts you're familiar with, like the employee health insurance, the employee retirement plans, and the state and local taxes paid on behalf of the employees by the employer. So that's just a total amount. You don't, somewhere you have to add it up person by person, but here you just put the totals on lines 6, 7, and 8. The bottom half of that page starts with line 9. This is the owner compensation. As we just said, table 3, if you make one. Section 10, line 10 is the total payroll cost. So now you just add together the various lines above, 1, 4, 6, 7, 8, and 9. So now for the first time you have total payroll costs. And then the last section here, this is the FTE reduction calculation. And I said before, if you don't get your FTEs back to a certain level, you will get penalized or get a haircut equal to a percentage. And this is where you compute that percentage. So line 11 says the average FTEs during the borrower's chosen reference period. And again, we started this webinar by assuming this isn't the first webinar you've listened to on PPP. So hopefully you have some base level of knowledge. And there's a whole bunch of different FTE periods you look at. In one place, you look at February 15th of 2019 through June 30th of 2019, and you determine your average FTEs during that time period. You also look at January 1st of 2020 through February 29th of 2020 and figure out your average FTEs from that time period. And then you get to choose whichever one of those 2 time periods gives you the better answer. So off to the side, you will have done that work. You will figure out which of those 2 numbers is better for you, and that's what you'll put on line 11. Line 12, you just go to table 2 and table 5. I'm sorry, table 1 and table 2 on lines 2 and lines 5, and you add your 2 FTE numbers together to get where you're currently at. And then on line 13, you take where you're at today or during the covered period divided by where you used to be during whichever period you picked, and that becomes a decimal place, and that becomes the penalty. And as you'll see on the instructions for line 13, if you did meet that safe harbor on the very bottom of the worksheet, you can ignore lines 11 and 12 and you just put 1.0 on line 13. So that's it for Schedule A. With Schedule A complete, you now move backwards again through the packet to page 3, and page 3 is the actual calculation form for forgiveness. At this point, you're only 11 lines away from figuring out how much of your loan is going to be forgiven. The entire top half of the page is general data, name, address, loan number, employee numbers, that kind of stuff. As a reminder here, it asks if you did an EIDL loan and if you've got an EIDL advance. That was the up to $10,000 advance that you got automatically just for applying. And the caveat there was if you get that advance, but then you also get forgiveness under a PPP loan, they will deduct the advance from your forgiveness. So this is where you tell them if you got any or all of that $10,000. The bottom half of page 3 is the last of the calculations. And again, not particularly difficult calculations at this point. Line 1, payroll costs, copy that over from Schedule A. Lines 2, 3, and 4 are the non-payroll costs. These are the things you've been tracking, like your business mortgage interest, your rent and lease payments on anything that was in place prior to February 15th, and same with your utility payments. So you add all those together. And then we start taking these quote unquote haircuts or penalties that we've talked about. So you add all those together, and then on line 5, you put the total salary wage reduction amount that was calculated on Schedule A. That's all the different people that have negatives get added together. That goes on line 5. So you add 1 through 4, you subtract 5. That's what line 6 is. Line 7, you bring over that percentage we just talked about from the FTE reductions on Schedule A. You drop that percentage in there, and then on line 8, you take 6 times 7. So one of the things we were wondering about all along was what order were they going to do some of these calculations in? They were always sort of silent on that in the instructions and in the law, and it wasn't until we got the application that we sort of figured out we were going to take the dollar reduction first and the percentage reduction second. And for those of you who remember your algebra or whatever, it would have made a big difference if it went the other way. So then you get to lines 8, 9, and 10, which they've labeled as the potential forgiveness amounts. There's 3 different numbers here, and your ultimate forgiveness will be the lowest of the 3 numbers. So on line 8, it's just that math we just did. All your costs minus your wage reductions multiplied by your FTE reduction, that's a tentative forgiveness amount. Line 9 is the entire amount of your loan, because they're not going to forgive you any more than the entire amount of your loan, obviously. And then line 10 currently says payroll 75% requirement, divide line 1 by 0.75. We believe that'll get changed to be 0.6 when they release the next version of the application. Hopefully they don't make significant changes. Hopefully they leave it all the same and just make a small change like that. And that's where that either 75-25 or 60-40 rule comes in, to make sure that you're not weighted too heavily towards the non-payroll costs, the interest, the rent, and the utility. So you have 8, 9, and 10 finished. You pick the lowest of the 3, you put that on line 11, and you're done all the calculations, and you know how much of your loan you're asking the bank and the government to forgive. Before you can turn it in, you need to make certain certifications. That's what you find on page 4. And they're more or less the same types of certifications that you made when you applied for the loan in the first place, so they shouldn't be a problem for anybody. Basically, that the numbers are accurate and you didn't commit perjury and that kind of stuff. And then the application would be complete. So throughout the entire process, we've always seemed to have more questions than answers. They've always seemed to be slow in getting us answers. Sometimes we get answers from the FAQs, the frequently asked questions that they post on the Treasury and the SBA website from time to time. I think they're up to maybe getting close to 50 of those FAQs. They also release what they call IFRs, or interim final rules. There's probably about 15 of those at this point. They answer some of our questions when they release one of those and we read them. But actually this application itself, when it came out back on the 15th, answered quite a few of our questions that we had otherwise been waiting for. So some of the things that we learned from the application itself: does rent include both real and personal property? Up to that point, we didn't know whether it was just rent of a building or whether rent of like a copier, a postage machine, maybe even a vehicle like a delivery truck or something. And the answer is yes, it does include personal property. Are there any recurring item exceptions to the incurred and paid concept? Ben covered that with how the utilities, you might actually get 3 months worth, and the alternative covered period, how you could align your payroll period to be what makes it simpler. Do vacation and sick pay amounts count towards the $100,000 per employee limit? Yes, they do. There's a way that you could read the law that would seem to say it's limited to $100,000 per employee, and then you can add the vacation and sick pay on top of that. They clarified that that's not what they meant. In what order and to what amounts do you apply the various forgiveness reduction rules? We just went through that. You take the wage reduction dollars first and the FTE percentage haircut second, and the whole 75-25 or 60-40 is sort of off to the side as an entirely separate calculation. What's the definition of an FTE? Literally, when from the time this program started on April 3rd was the first day you could apply, until this document came out on May 15th. We didn't know what they meant by FTE, which should have been the easiest question for them to answer. But in any event, they finally did tell us that it was 40 hours per week, and they gave us that shortcut 0.5 method if we wanted to use it. I'm going to make sure we have time to answer your guys' questions. So I'm going to go over I'm going to skip the rest of these so I don't take too much time. What are unanswered questions still? When it talks about mortgage interest, it says it can be mortgage on mortgage on personal property or real property. I, to this day, don't know anyone who knows exactly what a mortgage on personal property means. Does that mean any loan that's secured by equipment or secured by inventory? We're waiting for an answer to that. In the utility section, they refer to transportation. We don't know what that means. People want it to mean gas, like if you have delivery vehicles or company vehicles, but there's no indication of exactly whether it does or doesn't. Tax-free, Ben already talked about the tax-free part. and some of the uncertainty there. And then there's a whole bunch of questions about allowable uses of your money, not just forgiveness, but what you're allowed to spend the money on. And this application didn't help with any of those, and that's, I guess, not really a surprise since this was a forgiveness application and those were allowable questions. As has been the case every step of the way, it's one step backward, one step forward, two steps backwards, because every time we get some answers, it also raises new and unique questions. So from the application itself, there's a whole bunch of specific rules to owners that hadn't really been addressed before, but then they didn't make it clear exactly what counts as an owner. It's pretty clear that if you file a Schedule C that you count, and if you're a partner in a partnership, you count. It's pretty unclear whether shareholders and C corps and S corps are considered owners or employees. Which one takes precedent? And then once you get into owners, there's a series of questions, attribution rules. What about the spouse? What about the children? What about the parents? The way the form flows, the benefit amounts, the health insurance and the retirement and stuff comes after the employees are listed, but before the owners are listed. And that seems to imply that maybe they don't want you to include the healthcare and retirement and that stuff of the owners, but they didn't come out and say it. So it's up to you how you want to interpret that at this time. The next one's particularly frustrating, I think, at least for me, the FTE safe harbor that we talked about. In one place, it asks for the number of FTEs as of June 30th, maybe to change. Remember, everything in blue could change, versus not later than June 30th. And as of is a lot different than not later than. What if I hit the number? What if I hit my number that I need to hit on June 15th, but then on June 20th, somebody quits and somebody else gets fired or whatever? We have to lay some people off because we lose a customer or something. So which one is it, as of or not later than? We don't know, but now I guess we have until December 31st probably for them to answer it. Ben talked about incurred or paid. Ben talked about the 60% cliff. The way that the new law was written would appear to be an all or nothing test if you don't hit the 60% as opposed to some kind of prorated portion. And then the one I skipped over was just sort of, is there any limitations? So there's all these safe harbors. If something happens, I'm just going to use June 30th for now. If you hit the right FTE number on June 30th, it appears that there's no harm, no foul, all is forgiven. But then does that mean you can turn around and have major layoffs or major reductions the next day? And it doesn't seem to fit the intent of the law to do that. But at the same time, there's nothing in the law that would seem to say that you actually can't. So is anyone overwhelmed at this point? Is anyone feeling like this is a whole lot of work? By the way, when the government puts out a form, I don't know if you've ever noticed this, on the last page of every form, they have what they call the Paperwork Reduction Act, and they have a couple of standard governmental regulation languages, and then they always have a sentence or two on how long they estimate that it will take to complete the form. So like when you go to do your own tax return, if you look at the 1040, it tells you it should take this amount of time, and if you're filling out a quarterly payroll tax return, it tells you. So this form says it should take 3 hours to complete the form. And I guarantee you, most of us have spent more than 3 hours at this point just reading the instructions and playing around with the information that you need to gather. So it's a big undertaking. There's a lot of information. You have to pull data from a lot of different places. Obviously, hopefully today this has helped you some with what it's going to take to apply and to get organized. Beyond today, we have resources available to help you as well. We've done 2 prior webinars on PPP, and those were a lot more detailed, focused on the provisions, the rules themselves, exactly how the calculations work with numerical examples and things like that. So they've been recorded and they're on our website if you're interested in watching those. We've also developed a workbook that you may or may not have heard about up till now. It's been used, last time we checked, it's been downloaded 35,000 times between our website and the CPA firm that helped us develop its website. And then spread, I'm sure, from friends to friends beyond that. But it helps you gather all the data you need, get it organized, get it into a couple places. It does all the calculations for you. It even fills in the form that you need to submit, and we'll look at that in a minute. So if you're interested in using that workbook, the place to get that from is our website, which is www.cpabr.com. And we have currently 4 versions of the workbook. Because depending on your payroll cycle, whether you're a weekly or biweekly, or whether you're monthly or semi-monthly, There's 2 different versions for that. And then depending on which of the FTE models you want to use, the simplified 0.5 method or the actual method, you'd have to pick which workbook works for you. We have not updated any of them yet. We were waiting for the president to actually sign the law just to make sure nothing went wrong. Obviously, that's now happened. I need to go back and clear some people's schedule and get them working on this over the weekend and early next week. So we will be revising all those and getting them out there to accommodate these new changes. So again, if you want to download these workbooks, and we're going to pull one up here and take a quick tour of it in a minute, but you go to our website, as I said. While you're here, if you want updates when the workbooks are available, or if you want updates as we post articles and things, just go ahead and click on Contact Us, and then over here to the right, there'll be a little place where you can just put your name and email address. That's all we ask for is name and email. We're going to try to answer as many questions as time allows and as Jordan gets to us, but a lot of times we run out of time and don't get to all the questions, or you get off the webinar and then you realize, oh, this was the question I should have asked or meant to ask. We have a task force of full-time accounting people who have studied all this PPP stuff, all this, the CARES Act in general, the non-PPP stuff, and are available to answer your questions. So if you click this Speak to a Boyer Ritter Professional button, a little form will come up where you can basically email us a question. We'll get back to you. The next button over is the Resource Center. That's where we have the videos I talked about and some articles and stuff that we've written. To get to the workbook, you click down here on this blue box. So like I said, the workbook gathers all the information, gets it organized, and if you fill it in completely, hopefully you're seeing this PDF on the screen. This is a PDF file of the printout of the output of the workbook, including the headers, including the footers, including the little SBA logo. If you had this side by side with what the SBA gave you or your bank gave you, you wouldn't be able to tell the difference. So this literally types it in, fills it out, does all the math for you if you fill in the workbook completely. So like I said, I'm going to do this quick because I do respect everybody's time, don't want to go over, and want you to have plenty of time to ask us questions. So this is going to be a very high level, very quick review of the workbook. There are 2 instructional videos in addition to the webinars that are out there. There's 2 instructional videos on how to use the workbook that go into the functions, the features, and the formulas in a lot more detail than I'm going to. So I would certainly encourage anybody who wants to check those out. But basically, an orange tab means there's information for you to enter. A blue tab is just sort of information for you to read. We have an introduction to what's going on, instructions. The introduction is more about the law. The instructions are more about the workbook. Because of the unknowns, we have to make assumptions. You have to, when you get to a fork in the road, you got to make a decision if you're going to build an Excel book. So these are the assumptions we picked. They might be right, they might be wrong. You might not agree with them, but read them so at least you know what we're doing here. We copied over the documentation tab from the SBA workbook so that if you're trying to remember where to get the information from or what you might need to keep for later on, it's sort of always right there at your fingertips. Green tabs are ones that are just going to be printed out at the end that are output, and we'll look at those when we're finished. So basically though, look for orange cells on orange tabs. And if there's an orange cell on an orange tab, you need to enter it in order for this thing to work correctly. So on the cover tab, when did you get your money? How much money did you get? How often do you do payroll? Help us figure out your payroll calendar by figuring out the next pay date. And do you want to use the alternative covered period or not that Ben talked about? Application information, this is all just name, address, account number, number of employees. It's all the stuff to complete the top half of that application page that we wouldn't otherwise have, and therefore it makes it a complete workbook. There's a tab called Forgivable Cost Base. Most of the numbers on here pull from other places, but this is where we gather the non-wage payroll costs, healthcare, retirement, and state unemployment, and where we gather the non-payroll costs, the interest, the rent, and the utilities. So you enter all those amounts here. That's all you need to do on this tab. Step 1 has to do with all the FTEs. If you do weekly payroll, even under the 8-week scenario, there was like 42 weeks that you needed to look at in order to do all the calculations. I haven't even thought about what the 24-week one's going to look like yet. But these are all the different periods where we need to know how many full-time people you had and how many part-time people you had and what kind of hours they worked in order to do all those averages. So once you fill in the dates on the cover page and you tell us whether your payroll is weekly or bi-weekly and that your payroll ends on a Wednesday or a Friday, all the dates in this thing will update for you so that you know which payroll reports to look at. You don't need to do any prorating or allocating or anything like that. If it's a pay period that's split in half and part of it's in and part of it's out of the proper time period, the system will do those calculations for you. So you can just enter the entire amount off of the report that you're working from. So orange needs to be filled in. There's some periods that we don't need you to fill in because we're already going to have that information from another part of the book. So again, head count, hours worked, orange cells for all the different dates. That's step one. Step two is where we start to gather actual employee data. Last four of the social, last name, information on how much they made in the first quarter of 2020, because that's a measurement period for everybody. So you have to either, if they're hourly, you put in their average hourly wage and the average number of hours they worked per week throughout the first quarter. If they're salary, you can put in their total wages and then how many weeks they worked so that we can do all the math. There's 5 questions we need you to answer for every single employee. The answers to those questions will determine which exceptions they meet, which safe harbors they meet, whether they go on table 1, table 2, or table 3. This is what drives all that. Hopefully, just this little blurb up here is enough for you to know what we're asking, but if you need a reminder or a better explanation, you can just click here. Anywhere where you see black, there's logic built into this thing. So employee 1, if you start them as being a salaried person, we don't want you to also put in hourly information for them. It's kind of one or the other. That was an error. You can't put 0 in here because if you're putting anything in here, it has to be at least 1 week or up to 14 weeks. So if they were hourly, whoops. If they're hourly, all right, well, I should clean this up before I try. I don't know what I'm doing wrong. But in any event, if you fill in one side, the other side won't work. When you come over here, this question is only relevant if you answer yes to this question. So since you answered no here, that goes away. Owners can't be FTEs. So if you answer yes to owner, you can't answer the FTE question, that kind of stuff. So anywhere with a black box, it's trying to tell you that you shouldn't be using that field. So first quarter data, answer 5 questions for each employee on step 2. Finally, on step 3, this is where you do their actual payroll during your covered period, the 8 weeks. This is what we need to extend to now to 24 weeks. And this tool is used, it's a planning tool. It's an estimating tool, and it's a planning forecasting tool. So if you're 2 weeks into your 8 weeks or 3 weeks into your 8 weeks, you still enter what you expect to happen the rest of the way for each person so that you can see what you're tracking to get to forgiveness and maybe decide, hey, I need to add some people, I need to pay people some more money, or I'm overspending, I need to figure out some ways to scale it back or something like that. So when you get it, every period will be a forecasted period. You can enter in all the amounts. As you close a payroll cycle, you enter in the live data. Let's say period 3, you just did payroll on Friday, you change it to actual, you put in your actual data, and then it knows that these periods are actual and the remaining periods are forecasted. After all the periods are over, you'll see the total that you spent on a person, how much of it was forgiven, if they have any reductions, and if they're eligible for any of the FTE reductions. All of that pulls to the owner table, which is table 3, if you will, pulls to table 2, pulls to table 1, and then all that pulls to the application and will determine how much of your loan is, how much of the loan you're asking the bank to forgive. Then you'll give them all the backup, and they'll decide how much they are going to forgive, if they're going to approve it, if they're going to ask any follow-up questions. So Jordan, look at that. I think we're almost spot on an hour. So Jordan, kind of questions do you have for us?
Yeah, Ben, Jay, once again, thank you so much for doing this. I mean, what a process this all seems to be, but you guys have definitely simplified it as best you can. So I really appreciate you coming on and telling our membership all about this process. Really, you guys did such a great job. So as of now, we only have 2 questions, but guys, feel free to put in the chat area. If you guys have any questions, be happy to ask them here after these 2. But the first one I have for you guys is, for new deferred interest only period, does this apply to only new applications? Does it need to be negotiated with lender for existing loans?
All right, so the original law said that there was going to be a 6-month window where you didn't have to pay any principal, pay any interest, pay any fees, and basically 6 months out is when you would make your first payment. That has been changed to not until all of this is figured out and that your forgiveness amount has been done, and that is for everybody. Everything that Ben talked about in the front half applies to every existing loan that's already out there, with the one exception of the 5-year minimum maturity.
Thank you so much. Appreciate that. Second question we have is, excuse me, does an owner/employee need to provide FTE documentation?
So owners don't go on table 1 or table 2. So you're actually not going to require, it doesn't require any information for them other than their compensation during that time period. So they're not subject to the FTE test, and they're also not subject to the wage reduction test.
And keep that in mind. I didn't mention this, and that's a good question. When you're doing step 1 of the workbook and you're going back into old payroll data, don't lose sight of the fact that since they're not going to be counted as FTEs now, you don't have to count them as FTEs back then. So they're going to show up on your payroll report, but subtract them out.
Thanks, guys. Appreciate that. And then the last question, as of now, if we don't get another one here, is can you comment again on the paid versus incurred expenses, please?
Ben, you going to take that?
Yeah. So for payroll costs, it's going to be whatever's in your covered period, and then you can include whatever's paid kind of after the fact for the payroll that was incurred in that period. So if your payroll ended, I'll say at the end of your 8-week period, you would get to use that whole thing even though it was paid after your 8-week period. Again, all that changes to 24 weeks. For the non-payroll costs, it's going to be whatever you pay during your covered period, plus you can include whatever was incurred kind of on the back end of the pay, or on the back end of your covered period, but was paid by the normal billing cycle. So you can, if you pay a bill before the covered period, we don't think you're going to be able to include it. But if you pay, 2 months or maybe even 3 months in the covered period, we think you should be able to include all of those. And then you'll also be able to include whatever costs were incurred but paid afterwards.
Thanks, Ben. Appreciate that. One more question. Bonus or 401k contributions? That came from the same gentleman.
Well, they're two separate questions. So there was actually an IFR that was posted that said you are allowed to pay your employees bonuses, hazard pay, whatever, but you were going to be capped at, well, it was $15,385. We'll have to see if it expanded to the 3 months. So to the extent you stay under that cap, you can give them bonuses. You can pay them more, but it's just not going to be forgivable. Unless you're an owner. We didn't really talk about it, but for owners, when they haven't defined owners, you're actually capped at whatever you made last year. So if you made $100,000, that's not a great example. Let's use half that. If you made $50,000, you can't pay yourself based on $100,000 during the period, even with bonuses or anything. As far as 401k goes, there's been a lot of questions on that, and the way it's written, if it's paid in the covered period, you can deduct it. And then you should also be able to compute your 401k based on the payroll in your covered period. So if you have a 3% match, or maybe it's we'll just use a flat 3%, you'll be able to take 3% of wages and make that payment and include that in your payroll costs.
Thanks, Ben. Next question. So if within the 24 weeks you used the PPP for only payroll and used it all, then this will be forgiven. That was the question.
It seems very likely that now with the 24 weeks, it's going to be much, much easier to get the 100% forgiveness. Because if you remember, the loan was based on 2.5 months worth of payroll, which roughly translates to 10 weeks, not exactly. And that was always the concern, was they were giving you 8 weeks to spend 10 weeks worth of money. Now they're giving you 24 weeks to spend 10 weeks worth of money. Now, just because you So let's take that out. So now you're at, let's say none of your numbers changed, or you spend significantly more than your loan amount, but let's assume your FTEs are only at 50%, or let's assume that you have some people who you're paying everybody out at 50% of what they used to make. So you have a lot of people in that salary or wage reduction amount. There is a scenario where you could spend 100% of your loan money on payroll costs only and still not get 100% forgiveness. There's facts, there's fact patterns that would generate that, but it's far easier to hit that than it was before this law was passed.
Alrighty, fellas. Well, that's all I have as of now. I mean, once again, you guys really did a great job. You knocked it out of the park, and I certainly appreciate you guys coming on and talking to our membership about this wonderful program. We'll leave you at that. Really appreciate it, guys. And yeah, there's their information right there.
Yeah.
And to everybody,
if you have any questions, email Ben all weekend long. He doesn't mind. He'll be monitoring his email and getting back to you. So just look at the one on the top.
Jay's taking the weekend off. He said he already worked a little hard. He worked too hard already this week. But yeah, guys, thank you so much for everybody in here today that has signed up. I'll send you a separate link via email that has this PowerPoint in it. And then once again, this webinar, Power Hour, whichever you'd like to call it, we'll post this on all of our different social media sites as well. So if you have any friends or colleagues that want to check this out that couldn't make it on here today, that'll give them the opportunity to do so. So once again, everyone, thank you so much for being here, and we'll chat with you all again soon.
Everybody have a good weekend. Thank you.
Thanks, guys. Bye.